Today we'll be talking about accounts receivable. Accounts receivable is an amount owed by a customer who has purchased a business's good or service. This amount is recorded in the account called accounts receivable, which is a current asset on the balance sheet as it's expected to be collected within the year, an example of which is an invoice. So how do we account for this? Firstly, we debit accounts receivable by the amount that we are owed and then credit sales revenue as the business has earned this revenue. Taking this example, we see that accounts receivable is debited by the amount we are owed and sales revenue is credited by the same amount, which increases assets and increases equity, which balances the accounting equation. So clearly, we're not interested in cash when talking about accounts receivable. We're interested in purchases made on credit. One area of interest is sales returns, which occurs when customers are unsatisfied with their product and wish to return it. This involves a customer purchasing a certain item on credit and then returning it back to the store due to their unsatisfaction with a certain aspect of the product. To account for this, we debit the contra revenue account sales returns and allowances to erase the revenue previously recorded. We then credit accounts receivable as we no longer expect to receive this amount. As seen in this example, the customer isn't happy with his purchase and therefore returns it. As seen here, we debit sales returns and allowances by this amount and credit accounts receivable by the same amount, which decreases the amount of equity and decreases the amount of assets, which balances the accounting equation. Now we look at sales discounts. So this is a discount offered by a business to incentivize customers to pay off their debts earlier because money now is more valuable than money in the future, as this money can be invested and have interest accrued in it to increase its value. To account for this, we debit sales discounts by the discount and debit cash by the full amount minus the discount, as this is the amount that we will collect. We also credit accounts receivable as we no longer expect to receive this amount. In this example, the customer can pay within 5 days and receive a 3% discount, which he does, so he receives a discount of $15. As seen in this journal entry, where the sales discount is debited by $15, cash is debited by $485, and accounts receivable by credited by $500, which decreases the amount of equity and decreases the amount of assets to balance the accounting equation. We will now look at the collection of receivable, which describes when the business gets paid. To record this, we debit cash as cash is entering the business and credit accounts receivable as we no longer expect to receive this amount. As seen in this example, where in the general journal, cash is debited and accounts receivable is credited by the cost price, increasing the amount of assets and decreasing the amount of assets to balance the accounting equation. Thanks for listening and happy accounting.